Welcome to Talk Tickers. Today, we're diving deep into the Q3 earnings report from payments platform Paysafe. And let me tell you, this one was a bombshell that absolutely cratered the stock. So, we're going to break down exactly what happened.
And when I say cratered, I mean it. The stock just fell off a cliff, losing more than a third of its value in only 2 days. The market's reaction was swift and, frankly, pretty brutal. So what on earth could cause a drop like that? Let's get into it.
All right, here's how we're going to tackle this. First, we'll look at the headline results. Then, we're going to unpack the two kind of conflicting stories the company is trying to tell. After that, we'll get to the real reason the stock tanked, that guidance cut. And we'll finish up with our take on the whole situation.
So, let's start with those top-line results. The story here begins with a miss. Right from the start, the numbers just didn't hit what Wall Street was hoping for, and that set a really negative tone for the day.
Okay, so if you look at the scorecard here, revenue was about $434 million, which was a miss of about 1.5%. Adjusted earnings per share, that missed by around 3%. Now, you might be thinking, hey, those aren't huge misses. And you're right. But in this kind of market, even small misses can be a red flag that something bigger is wrong under the hood.
And then you look at the official accounting numbers, the GAAP results, and the picture gets even worse. We're talking a net loss of almost $88 million. Now, management was quick to point out that most of this was a non-cash tax charge, meaning it doesn't really affect the cash in their bank account. But you know what? For investors, it just looks messy. It complicates the story and makes people nervous.
So this brings us to the real heart of the issue here. It's like there are two completely different stories being told about Paysafe this quarter. Management is trying to sell this narrative of strong growth and progress, but the market is hearing a very different story, one about profits getting squeezed.
Yeah, if you listen to the earnings call, the CEO, Bruce Lowthers, was really talking up the quarter. He was pointing to accelerated growth, strong execution, basically painting a pretty rosy picture. And to be fair, there were some bright spots.
And this really illustrates that conflict perfectly. Look at the good side. You've got solid organic growth, incredible 50% growth in their iGaming segment, and they're landing big clients like BetMGM. That all sounds great, right? But then you look at the bad side, and this is what the market latched onto. Pressure on their profit margins, delays in rolling out new products, and some operational hiccups. That's the stuff that really scared people.
Let's zero in on that margin pressure, because this is absolutely crucial. The company is getting more and more of its business from what's called the ISO channel. Think of these as third-party sales partners. The problem is, while this channel is growing like a weed, the profit margins are way lower. We're talking single digits. So even though revenue is going up, the quality of that revenue is going down, and it's dragging the whole company's profitability down with it.
Okay, so the Q3 miss was bad, but it wasn't the knockout blow. No, the real reason for the absolute collapse of the stock was what came next, the guidance reset. This is the moment where investor confidence just evaporated.
And here it is. This is the chart that tells you everything you need to know. Management took its full-year earnings guidance and just slashed it. They cut the midpoint by over 20%. A cut that big tells you one thing. This isn't just a blip. It means those margin problems we just talked about, they're not going away anytime soon. They're here to stay for a while.
And it wasn't just earnings per share, they also cut their EBITDA guidance. That's a key measure of profitability by a whopping $45 million. I mean, that's a huge reset of the company's earning power. It basically forced everyone on Wall Street to throw out their old models and ask, okay, what is this company actually worth now?
And to make matters worse, you've got the debt. Paysafe has a lot of it. We're talking over 5 times its annual earnings. With profits now expected to be lower, it's going to take them that much longer to pay down that debt. Their goal of getting to a more manageable level, that just got pushed way out, maybe all the way to 2027. That's a long time to wait.
And Wall Street analysts, they reacted just as you'd expect. They came out and absolutely slammed the stock. You can see it right here. Firms like RBC and UBS just took a knife to their price targets. And their reasoning was exactly what we've been talking about, those weak margins and the much slower path to paying down all that debt.
All right, so that's the damage report. The big question now is, what happens next? Where does the stock go from here? Let's get to our take.
We're giving this a market perform rating. And what that means is, after a 30+% drop, a lot of the bad news is probably already baked into the price. You've got this tug of war now between some real, legitimate growth drivers and these pretty significant financial risks.
So what this all boils down to is that Paysafe has become a classic show-me story. The positives, like that growth in iGaming, are real, but they're just being overshadowed by the debt and the margin pressure. So, the ball is firmly in management's court now. They have to prove to investors that they can fix these problems. We need to see them scale up their higher margin products, improve that cash flow, and start making a real dent in that debt. Their preliminary outlook for 2026 needs to be backed up by some serious execution.
And that really leaves us with the one critical question that's going to hang over this talk for the next year. Can this management team actually deliver on their turnaround plan before investors just completely run out of patience?
This is not financial advice.